So this is the personal tax paper we're going to start right now. And obviously, this paper is one of the optional paper for our level 4 AAT. Now, of course, the tax is divided into two sections for this level 4 AAT. We have a personal tax, we have a business tax, and most of the students, they prefer to do both, because if you do only one, you will have a gap for the other half. So it's always better to do personal tax and the business tax both. So let's look at the syllabus area. So this one will cover a few topics. And from this book, we're going to cover 10 chapters. And in this 10 chapter, we're going to cover employment income and some inheritance tax and chargeable gain, national insurance. All of this we're going to cover from the personal income point of view. So here, the corporation tax or the CT 600 will not be considered. So here we only talk about when an individual person calculate the tax for him. So sometimes we can say as a self-employed or sole trader, or an individual person like to calculate how much tax is payable to HMRC. That we're going to learn from here. Let's quickly look at the chapter area. Chapter number 1, we have a taxable income. This one is a very simple one to show some band. For example, how much should be the tax rate based on the income. So for example, if someone have a basic rate, someone have a higher rate, someone have additional rate, we're going to see all of this from chapter number 1. Chapter number 2 is the calculation of the income tax. So based on the income, how much tax the person need to pay, we're going to see from there. Chapter 3, employment income. Chapter 4, property income. Chapter 5, national insurance. Chapter 6, chargeable gain. Chapter 7, share disposal. Chapter 8, private residence relief and inheritance tax. And finally, tax and ethical framework. The last chapter is a theoretical question, so there nothing will be calculation there. So up to chapter number 9, we're going to cover all of this, and all of this will be covered from the individual point of view, not from the company point of view. Let's look at the exam structure. In the exam, the exam will be computer based. So all the AAT exam is a computer based, and obviously the result of this exam will not be immediate. So result normally can take up to 6 weeks. So when you do the exam, you have to wait 6 weeks to get the result. So of course, by this time you can start your another paper, you can do another exam, but after you're done the exam, you have to wait 6 weeks to get the result. So let's have a look what we're going to see from this situation. So here we have the assessment method. The assessment method, you can see it is computer based. So the exam will be computer based. Now computer based means the assessment will be on the computer. So any question you need to write, you have to type yourself, or you have to make the question answer based on the template the exam provided. So before the exam, I'll show you some template, some practice question, like exactly that one you're going to see in the exam. So for the time being, really don't have to worry too much about that. The next one, we have marking type. Marking type, half of the exam or more than half of the exam, it will be marked by the computer automatically. So it says partially computer and partially human. Human mark is only involved where there is no number. For example, if the question asks you any question from the theoretical part, any question from the ethics, so where you have to write all the answer. And of course, this answer will be separate for everyone. Let's say if the question asks you what is the implication of the capital gain tax if some person live here a few years and then move to another country, or what is the benefit to apply the PPR, this sort of thing they can ask. So if you write any answer, so all the student, they will answer this question. Individual student will have an individual answer for that. For that reason, this sort of question will be marked by the person, like human. Other than any calculation, for example, how much is the tax payable, how much is the national insurance, how much is the inheritance tax payable. So all the number will be calculated or marked by the computer, because everyone has to have the same number for that. The exam duration will be 2.5 hours. So we need to be careful when you do the exam timer will be on the exam, so you can see that time is going. So there will be a counting for the number for the time. So you can see the time will be start 2.5 hours. It will be keep reducing. And once the exam time is over, the exam window will be closed automatically. So if you cannot even finish the exam on time, the exam will be submitted automatically. So it's not like you have to be worried like, okay, I couldn't submit on time, the time is over. Not a problem, because even if you couldn't submit the exam on time, the exam will be submitted automatically for you after 2.5 hours. Let's have a look at the learning outcome. How many marks are you going to see from which area? Let's have a look. So number one, this topic is a very straightforward, and most of the time this question come from either multiple choice question, true or false, or connecting the right answer from the left and right box. So this question will give you 10 marks. It says, analyze the theories, principle, and rules that underpin taxation system. Then you have number 2, calculate a UK taxpayer total income. This is one of the easy one, and it's a very easy to get 28%. So you can get 100% from this question, because here you have to calculate the non-savings income, savings income, dividend. So you have to calculate how much tax the person need to pay to HMRC. So obviously that's quite easy, and most of the students, they get 100% of this question. The next one we have for the national insurance. So we have few types of national insurance. We have a class 1, class 1A. So the first thing we need to know, what is the threshold for the national insurance? So you need to know, okay, so this national insurance belongs to a person or for a company. Now we have a employee national insurance. We have employer's national insurance. The percentage is very simple. For the employee, the threshold is 12%. So whatever the national insurance, after taking out the threshold, you have to pay 12% on that. And on the other hand, the employer's NI is 13.8% after the threshold takeout. So we need to see all of this from that area, and we're expecting few questions in the exam from there. Then number 4, account for the capital gain tax. This is the most tricky area a student face in the exam. Sometimes a student find it quite easy, but most of the student, they get less marks in this area. If you open up the examiner report, you will see this question is quite tricky, and most of the student, they get less than 45% in this question. So I will be advised to you to make sure like you revise very carefully this chapter, because capital gain tax contains a lot of rules and regulations. So you have to remember that. Otherwise, it's going to be difficult for us to complete this area and get 100% from there. Then we have the inheritance tax. Now, inheritance tax is a quite interesting paper, interesting topic, because from here, you know, if the person is die and the property or the asset that the children or someone, the wife, if they get it by inheritance, what is the tax implication? So it is kind of a new area for all of us. And of course, like, it's not a very common thing that we use every day. So if you work in somewhere as an accountant, or if you work in a company, this is not the area you see every day, but it's quite interesting topic. So if you learn it, you'll feel like that's quite interesting. But in the exam, we're expecting 12 marks from here. It's a very important area, so you need to make sure you focus on that, but it's not difficult one. The next thing we're going to see, the assessment structure. Let's have a look. So the assessment structure is we have to score 70%. Every single AAT exam, we have to score 70% in order to score the pass mark. So if you don't get 70, you don't pass in the exam. So it's quite a little bit harder than any other exam we do for ACC or CIMA, where we have to score only 50%. But in the AAT, you have to do 70%. So we need to make sure like we make a plan which question will give us 70% in the exam. Now we're going to see how many questions you're going to see in the exam. So we can see here task. So in the exam, we're going to see total 12 questions. So this 12 question will be 13 questions. That will be from the whole syllabus area. Let's have a look. So task 1. that will give us from the written task, and it will be marked by the human, and that will give us 10 marks in the exam. Task 2, benefit in kind. Benefit in kind is a very common in the exam, and it will give you solid marks if you understand that. So the benefit in kind is all about when the company or the employer give any additional benefit to the employee. For example, if you receive a car, if you receive a loan, if you receive a furniture or television, anything from the company, and you're getting the benefit from that. I'm sure if someone work on the accounting field, you know, like we need to fill P11D every July to tell the HMRC this I'm receiving from my employer as a benefit. Then we have benefit in kind again, the third question, but this time it will be like other benefits. So we have a two, one only for the car and one will be for the other benefit. So car and fuel is a very common, it will be definitely in the exam, but the other benefit is all about the loan, furniture, any sort of computer, any sort of any other asset. So it could be anything. Investment income is a little bit tricky, but we need to know some rules from there, and also like the property income. So for the property income, we need to know which one is the allowable expense and which one is not. We need to know the difference between the capital expenditure and the revenue expenditure. So some of the expenditure we can claim as an expense, some of we are not. So we need to make the list, which one we can claim, which one we cannot. Then we'll move to the next one, task 6. Question number 6 will give you computation of the taxable income and the tax theorem. So this one is one of the very learning area. So how individual pay the tax. For example, if someone have a employment income, if someone have a property income, and someone have a dividend income. So what will be the tax? How the personal allowance have implication on the overall income? So all of this we're going to see from this task number 6. Task number 7 will be very easy. That is a national insurance. For the 4 marks, we'll definitely get this marks. There is no doubt for that, because there are only 2 rules we have to remember to get this 4 marks in the exam. Then you have a task 8, that is sundry issue. So here we have like the mixing of the few areas. So this question could be come from anywhere. So we need to revise every single topic we have in the book. So you cannot avoid anything, you cannot skip anything, because the exam will be the combination of everything. Then task number 9, this is the basic of capital gain tax. As I said, this is the most tricky area. And this one, chargeable gain or private residential relief, this sort of thing is a little bit tricky to remember, but it's not hard, like very hard. It is difficult. It is tricky to remember, but it's not that difficult. Task 10, taxation on share disposal. This is one of the question will be your last task, or sometimes task number 10. This is like when you buy a share and sell. So obviously the treatment for the share is a little bit different for the capital gain tax. So when we buy and sell something, if we make a gain, we have to pay the tax. So if it is asset, the treatment is different. If it is share, the treatment is a little bit different. So you need to know how does it work. Then we have capital gain tax payable, how much capital gain tax we need to pay. Inheritance tax, there's 2 last question from the inheritance tax. And this one is all about when the person is alive, when the person is dead. And we need to know what is the difference between the PAT and CLT. So that could be our new area. So PAT is when the person is alive, that is called PET. PAT is a potential exempt transfer. Potential exempt transfer. So when a person alive, and if the person give any gift or asset to someone, and if the person survive, or if the person alive for the next 7 years, so there will be no tax implication, it will be exempted. So for example, if a client come to you and asking like, I have some houses, so what will be the best way to protect this house to give my children or wife without paying any tax? So you can advise for the pet. And we have some CLT, that is called chargeable lifetime transfer. So we need to learn all of this from this chapter. So what is the best implication to transfer your asset to your family member or friends or anyone? All right, so this is our story, the 12th question that we have to be answered in the exam. And how the question look like and how to answer, we're going to see once we finish our course. Before the exam, we'll open one exam question with the exam window. I'll show you everything. So don't worry about that, like how the real exam look like. All right, so now we move to our chapter number 1. And I'm going to start from chapter number 1. I'll discuss the chapter basic area. And after that, we'll start solving some question. And if you have any question, we'll able to answer later on for that. Okay, so let's try to start number 1. Chapter number 1 is called taxable income. So let's have a look what you have here. What you're going to learn from this chapter. So you have a chapter overview. Chapter overview tell us what you're going to learn from this chapter. So let's have a look at this one, what you're going to cover from this area. So taxable income is all about the amount where the tax will be calculated. So taxable income, some income are exempted. And that's the reason we use the word taxable income. Because if the income is exempted, this is not the taxable income. So from the taxable income, we can see we have two things. One is net income and one is taxable income. Now, the net income is all about after setting off the personal allowance. So net income means less personal allowance. So it is all about our taxable income. So when you have a net income, that means like how much is my income from the different sources. And net income less personal allowances, that will give us the taxable income. We have to pay the tax because the personal allowance is the amount that is kind of the exemption. HMRC give it to us and they said like you don't have to pay the tax on this amount. For this exam, we're going to follow the personal allowance will be 12,500. Now, even though it is 12,750 in real life, but you really don't have to worry about that. For the exam purpose, we're going to use 12,500 personal allowance. So up to 12,500, we don't have to pay any tax. Now, the income we divide into 3 sections. The income can be non-savings, income can be savings, and income can be dividend. This is the 3 income that we have to consider in order to calculate the tax or the taxable income. Now, the non-savings income come from the different sources. The first one is employment. So whatever money I receive because I work for some company or somewhere, that is called non-savings income. Then you have a self-employment. This is also non-saving. Property, non-saving. Pension, non-saving. So all this 4 income is a non-savings income. We have to be very careful because you have to remember all of this. Then the next thing we're going to talk about the savings. Savings is only 2 things. One is the interest and tax amount received in the year. So normally the tax amount will not come in the exam. They'll give you some interest. So they'll tell you like you have some money on the bank and you receive some interest on that. And that will called the non-savings income. Dividend, we already know what is the dividend. Dividend is all about when you receive the profit. Now, if you're a shareholder, you receive the part of the profit. Now, this part of the profit, we call the dividend. So if someone asks you what is dividend, we can answer them. Dividend is the breakdown of the profit. So after tax, whatever profit you have, retained profit, from the retained profit, if you break it down in a small part, the small part is called dividend. Then you have the exempted one. So this sort of income is exempted. For example, don't tax any amount that is not allowed to have the tax. Now, we are only talking about the UK, so we are not talking about any other country. So of course, like we only see the rules that is belongs to UK. ISA, that is individual savings account. This one have a limit up to £20,000. Up to £20,000 is a free. If you have ISA, individual savings income, up to £20,000, you don't have to pay the tax. Now, sometimes when you give that tax planning to your client or to someone, you can mention all of this so that they can save some tax. damages, winning, or scholarship. So this sort of thing is exempted, but it will be hardly tested in the exam. The only one thing you're going to see in the exam, that is ISA, individual savings income. So this one will be in the exam. So you need to make sure like you know how to calculate all of this. All right, the next one, we have the personal allowance restriction. So personal allowance restriction is all about if someone earn more than £100,000. I want you to focus on this area. It's a little bit tricky. So personal allowance, we already know what it is. So up to 12,500, we don't have to pay any tax. So that means if my income is £13,000, that means up to 12,500, I don't have to pay the tax. So I pay only tax on 500. That's my taxable income. But if my income is 100,000, then my personal allowance will be reduced 50% for every £1. So for example, if my income, let's say if my income is 105,000. Let's say my income is 105,000, and up to 100,000, my national insurance, my personal tax remain 12,500. But if it is gross 100,000, then my personal allowance will be reduced. For every £2, it will be reduced to £1. So what does that mean? That means, for example, if my income is 105, so I'll have to minus 100,000. So from the 105, I have to minus 100,000. We have to find the difference, and the difference is 5,000. And this 5,000 is more than the threshold, so I have to divide by 2. Divide by 2, so it will be 2,500. So my personal allowance will be reduced by 2,500. So I'll say 12,500 is my normal personal allowance. From there, I have to minus 2,500. So my new personal allowance will be 10,000. This will be the tax-free. So after 100,000, it will be reduced half. Now, if someone income is 125,000, for example, if someone income 125,000, so you will see he will have no personal allowance left, because if I minus 100,000, so the difference will be 25,000. And if I divide by 2, that is 12,500. And if I minus 12,500 from 12,500, it becomes 0. So that means he will lose all the personal allowance. So if someone income exceed 125,000, no personal allowance for them. We're going to practice some question anyway, so don't have to worry too much right now, but you understand the concept. This is the main thing. All right, another thing we have to know, that is called ANI, that is adjusted net income. Sometimes the net income has to be adjusted. Adjusted means the amount could go up or down. Why? Let's have a look. So personal pension contribution or gift aid payment. This one sometimes we call PPC. PPC, personal pension contributions. So if I give any money to the personal pension contribution, my adjusted net income has to be increased. For example, let's say my adjusted net income, let's say my net income is 102,000. 102,000. And I give to my personal pension contribution or to the gift aid charity, let's say I give £2,000. So PPC, £2,000. That means my new net income will be 100,000, not 102. That will be ANI. ANI, that is adjusted net income. So I adjusted the figure. Why? Because government encourage us to provide some, well, to give some money to the pension. So if we give any money to the pension, so we can save this money on the tax purpose. So on the tax point of view, we can save some money. So if we give any money to the gift aid donation or to the PPC, personal pension contribution, this amount we can minus from our net income, so we pay less tax. Simple as this. But we'll do some practice anyway. So this is the story of chapter number 1 that we're going to cover today. So let's move on. Let's do some exercise and let's see how does it work. This is the template that you have to remember. You have to memorize this template, remember that. So this template is all about three things, as I said, non-saving, saving, and the dividend. Now we know the tax rate, dividend is 2000 is free. Up to 2000 is free. So whatever is the dividend, so first 2000 is free. Now, the reason I'm saying this thing, and savings income have some free as well. So if you are a basic rate taxpayer, then up to 1000 is free. If you are a higher rate taxpayer, then 500 is free. So that means zero rated tax. Now, the reason I'm explaining that, because when you have a personal allowance, it is a question like, from which amount I should offset the personal allowance first. So should I offset the personal allowance from the non-savings income? Should I minus the personal allowance from the savings or from the dividend? The reason we have to minus always the personal allowance from the non-savings income, because this one have no allowance, this one have no zero rated. So whatever I'm earning, I have to pay the tax. But for the savings and for the dividend, some of the money are exempted. So if I use my personal allowance first with the dividend or first with the savings income, that means I'm losing some money, because I can use my whole personal allowance where I have to pay the full tax. So that's the reason the personal allowance always has to be used from non-savings income. Okay, let's have a look at the little story. So employment income, non-saving, property income, non-saving, interest received, saving, dividend from UK companies, dividend. Then after that, we calculate the net income. Now, if there is any adjustment for the PPC or the gift aid donation, that we have to do it. Otherwise, we minus the personal allowance, and that's my taxable income. This template you have to remember. All right, let's move to the next one. Let's have a look what we have here. And let's see if we can do one example. So there are some rules here. Let's quickly read that for the individual savings income. They said, these are the special savings account a taxpayer can invest in. Individual may invest up to 20,000 in an individual savings account in tax year 2021. This could be in the form of cash, share, unit trust, or insurance policies. Investor may use their entire allowance on one type of investment or a combination of different investment. Dividend or IAS, dividend income from the share or interest income received from cash invested in IAS are free of income tax. Capital growth is also free of capital gain tax. So we need to remember every single line from here, because every single line we're reading is a rules. ISA may be opened by someone 16 years old or over. So to open a ISA account, individual savings account, the person need to be at least 16 years old. ISA contain investment other than cash may be only opened by someone at least for 18 years old. So if someone with investment, that person has to be 18 years old. All right, now we have an example. So we'll look at one example, and obviously we'll see how it goes. And from there, we will see how much you understand what we explained so far. Then after I explain and solve, then I'll give you time to ask me a question. And of course, like, you will be able to discuss more for that. So let's have a look at this question. Question number 1. Taxable and exempt income. Foster received the following income. So Foster is a person, he received the following income. So building society interest, so we can say it's a very clear, it is a savings income. So building society interest, so this is my savings income. We need to identify the category, which one is saving, which one is non-saving. Then we have dividend from the ISA investment, 900. So this is our exempt income, because we know ISA investment is exempted. Rent is 6,000. This is non-savings income. Rent, employment income, property income, all of these are non-saving income. Non-ISA dividend. So this is 450, and this is a dividend income. Non-ISA, it's not ISA, non-ISA. So it's a dividend. So you have to we have to learn how to categorize or how to identify this income belongs to that. And this will help us to understand how much is the tax rate or what is the implication for the tax. So we have a building society that is savings. Then we have a dividend from ISA. This is exempted. Rent is non-savings, and non-ISA dividend is a dividend. All right, let's read the requirement quickly. What is the requirement we have here? They give us a solution template. We have to just put the figure here. The exempt one, that is ISA dividend. So ISA dividend. This is exempted, and that is 900. So we're going to write 900. Then with the non-savings, we have rent. Non-savings, we have a rent. And the non-savings is 6,000. And we have a savings income, that is building society interest. Building society interest. And this is our 40 pound, that is non-savings income, building society interest. And finally, you have a non-ISA dividend. Non-ISA is a dividend. Dividend, and that is 450. And that's how we can categorize this income. So this is the very basic thing. It's not tough thing. So obviously, this is the starting of the question. So of course, this is not very difficult thing. All right, so let's have a look. The next one, before looking at the next one, let's have a look if you have any question. All right, so the next top point, we're going to talk about computation of the taxable income. How are we going to calculate the tax? Now we can see here, obviously you have already the idea about the non-savings, about the savings, and the dividend. So now we're going to see how we're going to calculate that. Let's look at one of the example. Here we have one example, illustration 3, taxable income. 2020 and 21, Joe has trading profit 3,000 and receive bank interest 17,500 and dividend 500. Joe taxable income for 2021 is, so how much is the taxable income? Let's have a look at that. So we have here the first one. You can see the trading profit from the business. Maybe Joe have a sole trader business or any sort of business, and he make a profit from there. This is non-savings, 3,000. Then the bank interest is always savings income. So bank interest comes as a savings income. And the dividend he received 500 is a dividend income. So far, we are not still calculating the tax. We are not calculating how much tax Joe have to pay. We are just calculating how much is the taxable income. So the amount Joe has to calculate tax on it. So now the net income, you can see 3 non-saving, 17,500 saving, and the dividend 500. Now it's very important to understand, like the net income could be adjusted because of the PPC or because of the gift aid. But in this question, we don't have anything. We don't have to make any adjustment for the net income. Then we have a personal allowance that is 12,500. We know that, and we need to make the breakdown. So as we said, the personal allowance first we're going to use against the non-savings income, because this is the one will give us more tax, because savings income and the dividend income, we have some zero rated, but not for any non-saving. So that's why this whole 3,000 I have to offset. So minus 3,000 from my personal allowance, 12,500. So I use 3,000 from 12,500 from here. And then if I minus 3,000, still I have left 9,500. And this 9,500 I'm going to use from the savings income. And that's how I use my whole 12,500 for the personal allowance. And the non-savings income becomes 0 because I offset everything. And savings income, I can see from 17,500, if I minus 9,500, still I have to pay tax on 8,000, and dividend I still have 500. So how much tax we need to pay? We still need to calculate that, but the taxable income is after the personal allowance. This is the way we offset the personal allowance from here. All right. Let's have a look one example, activity 2. Activity 2, we have a taxable income. So let's try to do this question. So in this question, they said Q earn a salary 3,000. So salary is 3,000 for 2021. He received a rental income of 1,000. Building society interest is this and dividend is this. So rental income, we understand this is non-savings. Then building society is savings and dividend is dividend. So you understand that. And have a salary 3,000. This is also non-saving. Okay, so let's have a look to the solution box and go there. So first one, we have the employment income, that is non-savings 3,000. Then we have a property income 1,000. That is also non-saving. Building society interest, that is savings income, that is 3,750. Then you have a dividend income, that is 5,000. And that's it. That will give us the net income. So 3 plus 1, it is 4,000. And saving 3,750. And the dividend is 5,000. So my total net income will be 4 plus 5 is 9,000 plus 3,750. So 12,750. Now I'm going to minus the personal allowance. Personal allowance 12,500. First, I need to offset from the non-saving. Remember always, I'll remove all my non-saving, make it 0. Then I'll go to the savings, 3,750. I'll make it nil. And still we have 4,750 left. I'll minus that. And I have 250 for the dividend. And 12,500, that gives me 250 in total. So only this one is a leftover as a taxable income, and everything is offset by the personal allowance. It's a very simple one. All right, so let's move to the next one. The next one we have here, that is a restriction on the personal allowance that you already discussed, but quickly have a look this one. It says if an individual has a net income excess of 100,000, then the personal allowance must be reduced. So if someone income is more than 100,000, then personal allowance has to be reduced. It is reduced by £1 for every £2. So after 100,000, for every £2, it will be reduced by £1. The personal allowance may be reduced to 0 if income is greater than or equal to 125,000. I already show how it is worked. So if someone is income more than 125, his personal allowance will be 0. So how it is worked? So let's say someone income is 125. So 125,000 minus 100,000. You always minus 100,000 because that's the threshold. So 25,000 is the difference. And you divide by 2. So 12,500. So this 12,500 I have to minus from the personal allowance. So total personal allowance is 12,500. If I minus 12,500 from there, so it will be 0. No personal allowance will be left. All right, so let's do some practice. Hopefully you'll understand more from there. Okay, let's look at this example 4 illustration. So personal allowance restriction. Kelvin has gross employment income 98. So the gross employment income is 98. Receive a building society interest 1,500. This is the non-saving, and dividend 5,000. So you understand his net income more than 100,000 because 98 plus 1,500 plus 5,000. So net income is more than like 104,000 or 5,000. So we understand that. So you can see net income is non-saving 98, savings is 15, and dividend is 5. So total net income for him 104,000. Now, of course, if it is more than 100,000, the personal allowance figure has to be reduced. Let's have a look how to do that. First, we make the net income, that is 104, minus the income limit, that is 100,000. Find the difference, 4,500. And this 4,500, we have to make the half. So you have to make it divide by 2, make it simple. So if you make divide by 2, it will be 2250. And this 2250 you have to minus from your personal allowance. And the new personal or adjusted personal allowance will be 10,250. So if your income is more, you might lost all of your personal allowance. Okay, so, and after that, you can adjust it from the net income. From the non-saving, you can minus only 10,250, not 12,500 anymore. Okay, let's have a look if there's an example for that. Okay, let's try that. Personal allowance restriction. Let's try this one. It says, personal allowance restriction. Karen has a net income 107,000, all non-saving income. Okay. What personal allowance does Karen receive for 2021, and what is her taxable income? So personal allowance and the taxable income. So it's a very simple, it's not very difficult, because personal allowance need to be adjusted because the income is more than 100,000. So let's do that. We said 107 is the total net income. We minus 100,000. And the difference is 7,000. And this 7,000 we have to divide by 2. That is 3,500. And this 3,500 has to be minus from the personal allowance. So normally the personal allowance is 12,500 minus 3,500. And that will give us how much? 9,000. So the new personal allowance will be 9,000. And the taxable income, obviously we minus it from there. So that is 107 minus 9,000. And that will give us 98,000. This is a new personal, the taxable income. So it's very simple. All you have to remember, how much is the net income? You have to minus the 100,000, find the difference, divide by 2. And this amount has to be minus from the personal allowance figure 12,500. And this will reduce the amount. This will be your adjusted personal allowance. And personal allowance need to be minus from the net income to find the taxable income. All right, it's not very difficult one, but you can write it down. If you have any question, we can discuss later on. Let's move to the next one. This is another little bit tricky area. So gift aid donation and the pension payment. As we discussed before, we have two things. One is PPC, personal pension contribution. And we have also, what's that called? The gifted donation. So gifted donation and the personal pension contribution, these two will be adjusted with the net income. So it will reduce your net income and you'll pay less tax. So let's have a look. How does it work? Let's read one of the example from here first. So we have here illustration number 5. Personal allowance restriction with gift aid payment. Personal allowance restriction with gift aid payment. As per illustration 4 in 2020 and 21, Kelvin has a gross employment income of 98,000. So gross employment income 98,000 and receive building society interest 1,500 and dividend 5,000. However, he now makes a gross payment to charity of 1,000. So you're making a gross payment 1,000. Here it is a little bit tricky. I'll show you how to make it less, but obviously for the time being it's not going to be difficult. When you calculate the tax, this thing has to be gross up. So if he paid 1,000, you have to gross up by 20%. But I'll show it later on when you do the actual question. But for the time being, just remember, if someone give any charity to the gift aid or any sort of personal pension contribution, it will reduce his net income. Okay, non-saving, saving, and the dividend total is 104. So we have some gross payment 1,000 he gave under the gift aid. Okay, so what we have here, so you can see here we have a net income 104, but we need to minus the gift aid payment or PPC, personal pension contribution. It will reduce his net income. So minus 1,000 and the new figure will be 103,500, and we called it adjusted net income. We called it adjusted net income. And from there, we minus the excess limit, 100,000, find the difference, 350 divided by 2. Divide by 2, it will give you 1750. And this one will be minus from the personal allowance. So normally the personal allowance is 12,500 and we minus 1750. And we know why we minus 1750, because if someone income is more than 100,000, we have to find the difference, divided by 2, and it will reduce by this amount of our personal allowance. So here, only the trick here is 1,000 need to be reduced because he makes some gross contribution to the gift aid or personal pension contribution. All right, let's move on to one of the example. Let's do that. Let's do activity 4. Personal allowance with personal pension payment. Let's try to do that. So you have Karen, who has net income 107. Now make a personal pension payment of 2,000 gross. What personal allowance will Karen receive? What is her taxable income? So two things, personal allowance and the taxable income. So let's have a look. The net income is 107. And we have a personal pension contribution 2,000. So you need to minus this 2,000 because that will reduce his income. So it will be 105 now. ANI, adjusted net income. Now we have to minus 100,000 from here to find how much the reduction for the personal allowance. So the difference is 5,000 divided by 2. So 2,500 will be reduced from the personal allowance. So normally the personal allowance is 12,500 and you minus 2,500 from here. So new personal allowance will be 10. So you're going to write personal allowance will be 10,000. And how much will be the taxable income? So he have some income here. So 107 is the net income, 107 minus 10,000. Personal allowance. That will be 97,000. Remember that the pension payment, personal pension payment 2,000, we only use to reduce the adjusted net income. But when you calculate the taxable income, you do not consider 105. Remember that you consider 107. Because the net income remains same, we only make the adjustment for the personal pension payment just to pay some less tax, just to increase the personal allowance. But when you calculate the taxable income, you have to consider 107 in order to find how much is the taxable income. Don't use 105. This one is only for the personal allowance adjustment. So you need to be careful with that. All right, let's move on to the next one, the tax planning. This is just a story, so I think it's the end of the chapter number 1. So this is our story of chapter number 1. We'll move to chapter number 2. But before we move, let's take some question if you have. All right, so the next chapter we have here, calculation of the income tax. Now here we're going to see how to calculate the actual income tax. So let's have a look what we're going to cover from here. So we need to remember some number from here. So let's try to look at. So calculation of the income tax. So income tax calculation could be really easy if we know the rules. So all you have to know, you have to remember a few formulas, few numbers, and this number also will be given in the exam. So all of your rate, the band, and for the allowance will be given in the exam. So you can always open that page to see what is the rate and everything. But it will be better if you can remember yourself, because during the exam time, you will be always time pressure. So you really don't want to spend any time to reading the question, and obviously it will be not helpful for the time management. So my advice will be always do the practice the way so you remember all the rates. So you really don't have to depend on the exam day. Okay, so income tax computation, tax liability and the payable, savings, dividend allowance. So let's have a look. The first thing you have to remember, the first thing, we have a non-savings, we have a savings, and we have a dividend. So up to 37,500, it is a basic rate, and the tax rate is 20%. So if someone have income up to 37,500 pounds, the person will pay tax 20%. If it is a non-saving, if it is a saving, then it is 20% again. And if it is a dividend, then 7.5%. So if someone income, including everything, the income is total 37,500, this is the tax rate. Up to 150, we called it higher rate. So the first one, we have basic rate or basic band, and this one is a higher rate or higher band, and this one is called additional rate or additional band. So up to 150,000, the tax rate will be 40%. The difference between 37 and 150, the tax rate will be 40%. And for the savings, 40%. For the dividend, 32.5%. And finally, if someone income is more than 150,000, so anything excess of 150,000 or more than 150,000, the tax rate will be 45% for the non-saving, for the saving 45, and for the dividend 38.1%. So this rate has to be on our head because we cannot rely on the tax note on the exam paper, on the reference material. So we need to make sure we practice enough so that this figure always on our head. Let's look at some allowance. So personal allowance, you already know that. Personal allowance, 12,500 is exempted, is free. Up to this amount, we don't pay any tax. We know that. Now let's look at the savings income and the dividend income. On the savings income, if someone is a basic rate taxpayer, that means income is 37,500. So up to 1,000, so basic rate taxpayer, up to 1,000, he don't have to pay the tax. So if you are a basic rate taxpayer and on the savings income up to 1,000, you don't have to pay any tax. If someone is a higher rate taxpayer, then up to 500 pounds, the tax rate is 0%. You don't have to pay any tax on the savings income. Remember that is only on the saving. And if someone is additional more than 150, then he have to pay the tax. So it's not, there is no allowance for that, is 0. So if someone income is 37, after 37.5, so 1,000 pound savings income don't have to pay the tax. If someone income between 150 and 37,500, then 500 on the savings income, he don't have to pay the tax. And if someone is more than that, there is no allowance for that. He have to pay tax on every single penny he earned. On the other hand, dividend is free. Any rate is 2,000 is free. Doesn't matter how much is the income. Regardless of the income, 2,000 is always free for the dividend. So if you are a shareholder of any company, so you can take the dividend up to 2,000. And that's the reason you see sometimes the limited company, the person come to you and say like, how can I pay less tax? And you give them the tax planning. You advise them like, if you have a family member, let's say your children, your wife, your brother, you can put them as a shareholder. So everyone can take dividend 2,000, 2,000, 2,000, and it will be tax-free. So that's why you can see so many people that put a lot of shareholder or director in the company because they can take some money tax-free from the business. All right, so let's have a look at the next point. The next point we have here, payment to charity and pension payment. So payment to the charity and the pension payment. This one we already discussed that, gift aid and the personal pension scheme. Now this one is a little bit trickier. I want you to remember that. So this one is a net, pay net 80%. So basic rate taxpayer, high rate taxpayer. So relief is given when paid, no further implication. High rate taxpayer, gross up 100 to 80, extend the basic rate band and higher rate band. So this one is a very important. This is not very important, but this one is a very, very important. Deduct gross from the net income before calculating the personal allowance restriction. So if someone is a higher rate taxpayer, or additional rate taxpayer, what you have to do, you have to gross it up. We have to gross it up. What does that mean, gross it up? Gross it up means, for example, if someone give on PPC, if someone give 100 pound, we need to we need to make it 100%. We need to believe this is 80%. So if someone give £100, we have to believe it is 80%, and we have to gross it up to 100%. How we do that? So we times by 80. So let's say 80 times by 100 and divide by 80, and it will give you 100. So even though we are paying only £80 to the charity, we are giving only £80 to the personal pension contribution, but I will be able to make it 100 for the tax purpose. So I'll save more money, because HMRC allow us, like if you give a charity, because you are doing some good work anyway, so they give some tax advantage. They say like, okay, how much you pay to the charity, it will be treated as a net. It will be treated as a net. That means when you gross it up to 100%, so you have more money to claim as expense. So let's say if you give £80 to the charity, you can claim expense £100. So the way you can do, you times by 100 and divide by 80. So any amount you have, the way easy we can do is, for example, £80 and divide by 0.8, and it will make you 100. If someone give £500, 500 divided by 0.8. So divide by 0.80, it will make you 100% again. That's how we can gross it up. So if any personal pension contribution or any gift aid donation come, we have to always gross it up if the person is a higher rate taxpayer, because it's always considered pay net 80%. All right, we'll do some example, you understand that. And we have deduct from the employment income. This one you already know. So if we have PAYE, some tax, national insurance, it will be deducted. And if there's any scheme, for example, deduct employment income, so pay as you go system. Like for example, if someone give any occupational pension scheme from the employment, so it will be deduct from the employment. All right, so let's have a look at some story here. A taxable income, tax payable, taxable non-savings, savings income. There's a lot of things. You can read everything. It's so helpful for you. I just want to see which example will be more helpful for us to understand. Savings income. Okay, let's do an example from here and let's have a look if we understand that. Okay, it's a very simple one, I think. Calculate the income tax liability. This time we're going to calculate the income tax. So let's have a look at that. So we have the first one, we need to know the differentiation of the income, how many types of income we have. So let's have a look. Julie, who is a single and has employment income 39. So employment income is a non-saving income, we know that. And building interest is 9,000, that is savings. So 39,000 is non-savings and building is a saving. So you already categorize these two income. Now the next thing we have to do, we have to put it in the right box to see how much is the total taxable income. So let's do that. We have employment income. Employment income, that is 39,000, that is non-saving. And we have a building society interest. So building society interest, that is savings income 9,000. And this is 39 total, 9,000 total. And we have a net income, there is no adjustment for the PPC. It's a net income. So this is 39,000. This is 9,000. And the total is 39 plus 9, 48,000. All right, this is the story. Now we have to set off the personal allowance. So we already know personal allowance, we always have to minus from the non-saving first. So you have 39,000, we're going to minus 12,500. And we can see we have a left. So that is called taxable income. Taxable income, 39,000 minus 12,500. That is 26,500. Here, the non-savings income, we have 9,000 and 12,500. If we minus from the total, and the total we have 35,500. So up to here, you already done on chapter number 1 as well. So it's not very difficult. Now we have to calculate the tax. How are we going to calculate the tax? And now we can see the total income is 35,500. So total taxable income 35,500, and this is less than 37,500, isn't it? Because 37,500 is the threshold. So if it is 37,500 or less, then it's a basic rate taxpayer. He's a basic rate taxpayer, and we know it is 20%. Basic rate taxpayer, the tax rate is 20%. And also for the savings income, he will get £1,000 allowance. So first 1,000, the tax rate will be 0%. So we understand that. Now let's calculate the tax. So we have the savings first, that is 26,500. So we do 20% on that. So 26,500 times 20%, that will be 5,300. And for the savings, we have a two calculation. For the savings, because first 1,000 will be tax-free, so you need to divide into two sections, this 9,000. So the 1,000 and 8,000. This 1,000 is a zero rated, no tax, and the 8,000 is 20% because it's a basic rate taxpayer. So it will be 0, and 8,000 20%, it will be 1,600. So how much is the tax total? So 5,300 for the non-saving, and for the saving 1,600. So total will be 6,900. That's it. That's how we can calculate the tax. So we have to first find the taxable income. Then we have to see what type of taxpayer he is. So you can see the total income is 35,500. That is less than 37,500. So we understand he's a basic rate taxpayer. And for that reason, he will pay tax 20%, and he will get allowance 1,000 for the savings income. So what we will do, 5,300 is 20%. And another savings income, 1,000 is tax-free, that is 0, and 8,000 20%. So 5,300 20% on the non-saving, and 1,600, that give us 6,900. All right, so let's take some question if you have. The next point, we're going to talk about extending the band. Now, it's a very important point, extending the band. Extending the band means like how to extend the basic band. So basic band or higher band, we know the band. So the tax rate when the amount is up to 37,500, we called it basic band or basic rate, and up to 150, we called it higher band or higher rate. Then anything more than 150,000, we called it additional band. Now, the question is like sometimes this band could be extended. This band could be extended. For example, our basic band is 37,500, and it could be extended to more. So that means more will be added, and the new band or adjusted band will be more than 37,500 if there is a charity or if there is a contribution to the personal pension scheme. So let's have a look. Certain donation to UK registered charities or payment to into personal pension scheme are eligible for the tax relief. So certain donation to UK registered charity or payment into personal pension contribution are eligible for the tax relief. That means if we give any charity to the registered in the UK and the personal pension scheme, what will happen? We can extend the basic band. Let's have a look. How does it work? Let's quickly read this one. Essentially, the income the taxpayer put into the pension scheme gives to the charity is not taxable. The taxpayer therefore saved the tax they would have been paid on that income. Different taxpayers will therefore be entitled to relief of the different rates. Most taxpayers are employees who are already paid tax via the PAYE. By giving money to the charity or paying into a pension, they are therefore entitled to refund the tax already paid on this scheme. Most taxpayers pay tax at 20%, so making a payment of 100 would entitle them to repayment 20. It would be onerous for the taxpayer and the government if everyone who made such payment had applied to the government for a tax refund. So to simply the administration payment will always be made net of the basis rate 20% of the tax. The charity pension will then reclaim 20% from HMRC on behalf of all the donors is one go, saving time and effort. So basically what they're saying, the charity is a tax-free. So rather than you give the charity and you ask HMRC, can I have my tax back? So it's going to be a lot of people, they do that, they give the charity and they will keep asking the tax back. So rather than doing that, what HMRC did, the HMRC allow you to extend the band, so extend the basic band. So what is happening here, you can see the basic rate upper limit. So 37,500 is the basic rate that we already know, but it will be added plus payment times 100 divided by 80. That means the gross. So for example, if I give a charity, for example, if I give a charity 80 pound, so I make a charity 80 pound. So how much will be my new basic band? So what will happen? So I'll say my basic band is 37,500. My basic band is 37,500, and I give some charity, so it will be extended. How much will be extended? Not 80, but I have to gross it up first. Remember that. I have to gross it first. So 80, I need to make it divide by 0.80, and that will be 100. And this 100 will be added with my basic band. So it will say gift aid or charity or PPC, whatever. We need to add it this one. So it will be 37,600. That will be my new basic band. So what you understand? With the 37,500, we have to add it the gross amount, not the net. Remember that. It is very tricky. Sometimes in the student, they just added whatever exam given, but don't do it because you have to make it gross first before you actually give, before you actually add it to the basic band. All right, so let's have a look. How can we do that? And obviously, if there's additional rate, we save more tax, and I'll show you how we save the tax for that. Okay, let's look this example, and it will be helpful for us to understand. Gift aid donation. Gustav has taxable income, all non-saving, 50,000. So he's a higher rate taxpayer, we understand, because he is he's earning 50,000, more than 37,500. So he's a higher rate taxpayer. Assuming that Gustav does not make any gift aid donation or personal pension contribution. So there is two situations. The first one is there is no gift aid donation. The next one, there is a gift aid donation. So it's very nice. So if he don't give any donation, what will happen? So 37,500, 20%. Remember, is a taxable income. Taxable income means after the personal allowance. Remember that, very careful. Net income is before the personal allowance. Taxable income is after the personal allowance. So if the question said taxable income, that means it is after the personal allowance. So we said, okay. So taxable income, it is 50. So we have to pay the tax on 50,000. So 37,500, the first basic rate is 20%. So 37,500, 20% give us 7,500. And the rest, 12,500, the tax rate will be 40%, because after 37,500, even it is £1, the tax rate is 40%. So 12,500 times 40%, it will give us 5,000. So 5 plus 7, 500, 12,500 is our new balance, the total tax balance, 12,500. So this one, when he don't make any charity, don't do anything, is very simple. 37,500, 20%, rest 12,500, 40%. Very simple. Now, the new situation. Now think about the situation where Gustav make a gift aid donation, 8,000. Remember, this 8,000 is a net. We need to make it gross. How we make it gross? We divide by 0.80. Very careful with that. So you divide by 0.80 so that we make it gross. And after we add it with the basic rate. The gift aid donation has been paid net of 20% of the tax. This means that the gross amount of the payment 8,000, and we have to gross it up. So 8,000 times gross it up, 10,000. Okay, that's very simple. We know this one. We have to gross it up. And Gustav basic rate band must be extended by 10,000. So what will happen now? Let's have a look. The tax liability, 37,500, 20%, that is 7,500. Now the basic band is extended now by 10,000. So next 10,000, I will still pay 20%. So before it was 37,500. And because I give 8,000 to the charity, so 8,000 I gross it up, divide by 0.80 is makes me 10,000. So I added this one with the basic band. So my new basic band will be 47,500, and I'll pay 20% on that amount. So I said, okay. Then another 10,000, I pay 20% because of the gift aid. So it is extended my basic band. Then the remaining 2,500, it will be the higher rate, that is 40%. And this is the tax. Now you can see here, if I make the gift aid donation, my total tax liability is 10,500. If I don't make the gift aid donation, my total tax liability is 12,500. So it is here I'm saving how much? 2,500 extra from here. Now 2,000, I'm saving 2,000 here. And also, let's have a look. I'll show you. There's two savings here. Extending the basic band means 10,000 is more income is tax on the basic rate. Therefore, 10,000 is less income on the higher rate. The difference between the tax liability with and without the gift donation is 2,000. You can see that easily. So if I don't give the charity, it is 12,500. If I give the charity, it's 10,500. That means I'm saving here 2,000 anyway. Also, you can see I give the charity only how much? 10. But I'm considering how much? 10. I give charity 8,000, but I'm adding with the basic band 10. So we have a difference here as well, 2,000. So actually how much I'm saving? 2 plus 2, I'm saving 4,000 pounds. So you can see here, basic rate relief given by the net payment. So I'm getting some net payment relief because I'm giving only 8,000 to the charity, but HMRC allowing me 10,000 to add it to the basic rate. So I'm saving 2,000 here. Also, if I don't do the charity, it is 12,500. If I do the charity, 10,500. So I'm saving 2,000 here. So that's how I'm saving another 2,000, and I'm saving total 4,000 pounds. It's a little bit tricky, but if you practice a little bit, you'll be fine. So you need to know how it works. So if someone give any money to the charity or they give a donation or to the personal pension contribution, we have to gross it up, extend the basic band. So the person will enjoy the lower rate with the higher band. So we need to be careful with this one. All right, let's do one example. Let's try to understand more from here. Okay, so we have activity 3, tax liability with gift aid donation. In 2020 and 21, Charlie has the employment income 100,000. So Charlie has the employment income 100,000. He wished to make a donation 8,000 to the charity. So let's try to understand this question. So the first one said, this is the net. So that means you have to make it gross. Always, if you see the net 8,000, need to make it gross, divide by 0.8. That will give us 10,000. This 10,000 we need to add it with the basic band. Okay, let's calculate the taxable income, then tax liability. Then tax liability, if he does not make the donation, okay, so this one without the donation. Tax liability, he does make the donations. If he make the donation, tax save, how much is the tax save? Very simple question. Let's try to do that. So first we need to calculate the taxable income. Taxable income is very simple because you don't have to do any adjustment for the personal allowance because the income is 100,000. If it is more than that, then we have a problem. So he said employment income or net income, that is 100,000. And from the 100,000, we minus the personal allowance. So personal allowance, we don't have to reduce the personal allowance because it is not more than 100,000. So you get the full personal allowance, 12,500. And that is 87,500. This is the taxable income. Taxable income. Number 1, taxable income. So taxable income will be 87,500. Just minus the personal allowance from the employment income. That's it. Tax liability, if he does not make the donation, does not. So it's very simple. If it does not make the donation, we have to pay the tax on this 87,500. So 87,500, we have to divide in few categories. So he said 87,500. We need to pay first 37,500. 37,500. The tax rate is 20%. that is 7,500 always. So 37,500 times 20%. Then you have to do next next one, that is next how much is the difference. So 87,500 minus 37, so we have 50,000. So 50,000 is the difference. It's a higher rate, and this 50,000 will be 40%. So 50,000 times 40%, that will be 20,000. So 20 plus 7,500, that will be 27,500. This is basically our tax for the tax liability if the person don't make any donation. So we don't have to extend the band. So it's a 27,500 you need to pay if you don't make any donation. The next one says tax liability if you make the donation. Okay, so now we need to extend the band. So if you make the donation, so let's try to do that. So first we need to see how much is the total 87,500 anyway. So now this time we have to extend the basic band. Normally basic band 37,500 plus we need to add 10,000. So plus 10,000. So the new basic band will be 47,500, and here we have to calculate 20%. So 47 we have 500 is 20%. We have to pay the tax here 9,500. And also the remaining one, that is another 40,000. Total is 87,500, isn't it? From 87,500, so 47,500 is 20%, and rest of the 40,000 is 40%. And that will give us 16,000. So 16 plus 9,500, it will give us 25,500. So if you make the donation, it is 25,500. And the same question, how much you're going to save? So you can see here, the difference between C and B and C, that is like, if he does not make the donation, is 27,500. If you make the donation, is 25,500. So he's saving 2,000 here anyway. And also from here, he's saving 2,000 because he's giving 8,000, but actually he is claiming 10,000. So 2,000 he have here advantage. So 2 plus 2, 4,000 he will save. Now this question we just discussed a little bit earlier with the example is the is a simple, but it could be tricky if you don't practice enough. It could be tricky in the exam. All right, let's have a look a little bit more. Then we can take some question. We have a tax planning. I think this is the end of the chapter. Okay, so let's take some question if you have.